In 2007, Warren Buffett made a bet. $1 million. Against the smartest hedge fund managers on Wall Street. The instrument he chose? A boring, simple S&P 500 index fund. 10 years later, he'd crushed them by more than 50 percentage points. Here's a question that should haunt every investor. If complex strategies actually worked, why do the simplest investors keep winning? Today we're tackling one of the most counterintuitive truths in finance. Why simple beats complex, almost every single time. And the third example I'll show you is the one that breaks most people's brains completely. Let me tell you what actually happened in 2007. Buffett made a public wager. $1 million to charity. He bet that a plain S&P 500 index fund would outperform a basket of 5 hand-picked hedge funds over 10 years. Hedge funds managed by people charging 2% fees, plus 20% of profits. The smartest, most expensive money managers on the planet. When the bet ended in 2017, the index fund had returned about 125%. The hedge funds? Around 36% on average. Buffett's boring choice didn't just win, it tripled them. And here's the kicker. The hedge fund managers had access to everything. Bloomberg terminals. PhD analysts. Algorithmic trading. Insider conferences. Buffett's recommendation? Buy the whole market and stop touching it. But the real lesson isn't about hedge funds. It's about why this happens, again and again and again. Rewind to 1988. Buffett invests $1 billion in Coca-Cola. The whole world is chasing tech, leveraged buyouts, complex derivatives. Buffett buys sugar water. His thesis fit on a napkin. People drink Coke. They'll drink it tomorrow. They'll drink it in 50 years. The brand is a moat. The business is simple. The cash flow is predictable. That $1 billion investment is now worth over $25 billion. Not counting the billions in dividends Coca-Cola has paid Berkshire over the decades. A simple thesis. A simple product. A simple holding period, forever. Compare that to what most investors did in the late 1980s. They were piling into junk bonds. Conglomerates. Complex tax shelters. Most of those strategies blew up. Buffett just drank his cherry Coke and waited. Here's what I want you to feel. The harder a strategy is to explain, the more likely it is to fail. Now here's where this gets really interesting. Some of you might be thinking, but what about Renaissance technologies? Jim Simons? He used complex math to beat the market for decades. You're right. Renaissance's medallion fund averaged around 66% annually before fees from 1988 to 2018. Genuinely incredible. But here's what nobody tells you. The medallion fund is closed to outside investors. It's only for Simons and his employees. Why? Because the strategy doesn't scale. Renaissance's funds that are open to the public? They've been mediocre. Sometimes badly underperforming the S&P 500. The complex strategy works for one tiny fund and falls apart everywhere else. Meanwhile, a person who invested $100 per month in a simple index fund starting in 1990 would have over $500,000 today. No PhD required. No algorithms. No fees eating their returns alive. The lesson is brutal. Even when complexity works for a genius, it almost never works for you. So why do smart people keep choosing complex strategies? Because simple feels insulting. Our brains are wired to believe that hard problems require hard solutions. Investing seems hard. So we want a hard answer. But the market doesn't care what feels right. Charlie Munger said it best. It's not supposed to be easy. Anyone who finds it easy is stupid. Pause on that for a second. He didn't say the answer is complicated. He said the discipline is hard. The patience is hard. The not touching your portfolio is hard. Index investing pioneer Jack Bogle proved this with cold data. The average actively managed mutual fund charges fees that compound to roughly 30 to 40% of your lifetime returns. 3 decades of investing, and a third of your wealth disappears into management fees. For what? For underperformance. That gap, $700,000, is the price of complexity. Here's the principle I want you to carry. The market doesn't reward effort. It rewards discipline. The investors who win aren't the ones with the most information, or the most sophisticated models, or the fastest reactions. They're the ones who found a simple, boring strategy, and had the emotional strength to stick with it for decades. Buffett, Bogle, Graham, Munger. They all said the same thing in different words. Find a simple approach. Understand it completely. Execute it relentlessly. The compound effect of doing nothing exotic for 30 years beats almost every clever strategy ever invented. So here's my question for you. What's one investing decision you've overcomplicated that you wish you'd kept simple? Drop it in the comments. I read every single one. And if this changed how you think about investing strategy, hit subscribe. Tomorrow we're talking about the one financial habit that quietly separates millionaires from everyone else, and it has nothing to do with picking stocks. See you then.